Good. So when we talk of subsidiary, we have already explained that when an entity acquires another entity or acquires the controlling interest of another entity, which occurs by them acquiring more than 50% shareholding in another entity, the entity where they acquire more than 50% interest is referred to as a subsidiary of the entity that acquires the above 50% interest. While the entity that acquires the above 50% interest is regarded as a parent company to the entity where they acquire more than the 50% interest. Now, when we then talk of, simply means what? It simply means a subsidiary that is arising as a result of we acquiring what? Acquiring a subsidiary. In a subsidiary, though, we will still look at another situation, which is what we call a mixed group. The parent is not the one that has a direct subsidiary interest in the subsidiary. Rather, their interest in the subsidiary occurred as a result of their interest in the subsidiary. What do I mean? If as an individual I give birth, that child is being called, that baby is being called my child. Then if that child should now give birth also, then the baby will be referred to as my own grandchild. Now, the fact that I'm the father to the father of that child makes that child, in one way or the other, my child also, because we say it's still the same lineage, it's still the same lineage, and it's still we are all still coming from the same place. Are we getting it? So the interest I have in my grandchild is not as a result of me being the father directly, but as the grandfather. The fact that I'm the parent to the father automatically makes me a parent to the grandchild also. And that is why you see that, let's assume people give birth, what happens? They take them to their grandparents. Or maybe they want to travel for work, and for that reason, they will not be available to take care of the kid. What happens? They take them to their grandparents. If that is not the case, God forbid bad thing, but if the parents should die, what happens? The family, in most cases, so far the grandparents are alive, they take them to their what? To their grandparents. Because when we look at the relationship, those that have rights to those kids first, after their direct parents, are their grandparents. It is only when the grandparents are also not available, then we now start looking at other family members, like maybe we now start looking at other family members, like maybe um the father's brother, the father's sister, they are amongst other things. We now start looking at the extended family. But the first contact we will have, if there's any issue with the direct parent, is who? Is the grandparent. Now, having said that, when we talk of subsidiary, just like I've been saying, occurs as a result of the parent's interest in the subsidiary. The parents are not the one acquiring controlling interest in the subsidiary. Rather, the subsidiary became a subsidiary to the parent because the subsidiary actually acquired a controlling interest in the subsidiary. Now, having said that, we have two types of subsidiary relationship, because we call subsidiary a complex group. We have the vertical group and we have the D-shaped group. Vertical group and D-shaped group. So when we say vertical group, what do we mean? We mean what? We mean a relationship that exists more like a chain, or more like a straight relationship. A straight relationship. Let me give us an example of a vertical group. Let me give us an example of a vertical group. We have something like this. We have something like this. A acquiring interest in B, then B acquiring interest in C. Maybe A has 57% in B and B has 60% in C. Then automatically A becomes a parent to C. A what becomes a parent to C, not because they own C, but because what they own the owner of C. You know, in Yoruba we will say ẹni tó lẹ́rú ló lẹ́rù. Whatever I own, whatever what I own owns still belongs to who? Still belongs to me. That's what it means. If I own something and that thing also own other things, it simply means what? It simply means I own all of it. I own all of it. I could remember there was this story of a rich man that gave birth to only one child, and he tried his best in taking the child to the reasonable extent. And when the man passed and they were to share the inheritance, the elders, or those that are the executioner, like, or the executor of the estate, was like, according to the man's will, the child is only entitled to just one thing out of all of his father's properties. And after picking that one thing, the head of the slaves will be the one to take every other thing that is left. The child somehow felt betrayed and felt bad, but he was given like 3 days to think about it and come back with a speech of all his father's inheritance. Then the child consulted the elders and they gave him their wisdom. When it was time for him to pick, he picked the head of the slave, because the head of the slave is still part of his father's inheritance. And when he picked the head of the slave, automatically, whatever, even though the remainder of the property belongs to the head of the slaves, because he owns the head of the slave, that makes all the property his. And that was the message the man is trying to pass to his son. That if he is wise enough, he will pick what? He will pick the head of the slave. So that's just to tell us a brief story to relax the class. Now, when we talk of a D-shaped sub-subsidiary, that is where A owns B, same situation. Then B owns C. However, A also had a direct interest in C, though that direct interest does not give them acquisition rights. But with the combination of B owning C and they having a direct interest in C, it makes it a what? A D-shaped group. Let's say they have 60% in B now, and B has 80% in C. I'm not saying the percentage the parents will have in the subsidiary must be less than the percentage the subsidiary will have in the sub-subsidiary. But let's say B has 80% in C and A has 10% in C. Okay, that's what we mean by a D-shaped sub-subsidiary. A D-shaped sub-subsidiary. So that Moving on, when we have a subsidiary, the first thing we need to calculate is what we call effective interest. The first thing we need to calculate is what we call the effective interest. That is, now we are looking at the parent and the non-controlling interest. Now, what percentage does the parent effectively has in the subsidiary? What percentage does the parent effectively has in the subsidiary? To know the percentage the parent effectively has in the subsidiary, would multiply their percentage of interest in the subsidiary with the percentage, will multiply their percentage of interest in the subsidiary with the percentage of interest the subsidiary has in the subsidiary, with the percentage of interest the subsidiary has in the subsidiary. So going by this, my illustration I have created here, to calculate effective interest of A in C, A interest in C will now be 57% of 60%, 57% of 60%. And that will give us how much? 57% of 60% will give us
34.2.
34.2%. Now, the fact that it is 34.2% does not mean that we will now be treating C as an associate. No, they already have a controlling interest in it by virtue of B holding 60% in C. So even though the percentage is not up to 50%, we will still be treating what? We will still be treating C as what? As a subsidiary, meaning we'll still be consolidating the result of C and not treat C as what? As an investment in associate, which would have been the right treatment, if B is not the owner of C. You know, if B wasn't the owner of C, then what we would have done for C, if they had 34% interest in C, is to treat C as an associate, because with the 34% interest, that is between the 20 to 49 interest, we say an associate, that will create an associate position. But because this is a subsidiary, even with 34%, we'll still be consolidating. That is what effective interest is all about. Now, having said that, we move to the next thing. The next thing after determining the effective interest is to determine the date of acquisition. How do we determine date of acquisition in this kind of transaction? We'll look at, first, when did A acquire B? When did the parent acquire the subsidiary? Now, having determined the date the parent acquired the subsidiary, which will be the date they buy an interest that is above 50% in the subsidiary, we now look at when did the subsidiary acquire the subsidiary. It can be either of three dates. It is either the subsidiary has acquired the subsidiary before the parent acquired the subsidiary, or the parent acquired the subsidiary on the same day the subsidiary is acquiring the subsidiary, or the parent acquired the subsidiary before the subsidiary acquired the subsidiary. Now, how do we treat each case? If A acquires B, but let me take it this way. If B has acquired C, let's say in 2012, then A is now acquiring B in, let's say, 2014. Then the date of acquisition of A in C will be what? 2014. Because what gave them right in C is the result of the acquisition of B. So they cannot say they've acquired C before they acquire um B. Are we getting it? So the date they acquire C will be the same day they acquire what? B. But if A acquires B in 2020 and B also acquires C in the same 2020, then the date A is acquiring C will be what? 2020, because what is still give them the acquisition right in C is as a result of the acquisition of B. And since they both acquired on the same day, since from whenever they acquire B and B has interest in C, they've already acquired C. But where the case is that A acquires B in 2022, then B acquires C in 2025, then the date of acquisition of A in C will be what? 2025. We cannot say they've acquired the entity before they actually acquire, before their subsidiary acquires the entity now. So it is when the subsidiary acquire the entity that will be taken to be the date the parent also acquired the what? The subsidiary. Because don't forget, what is making us even say they acquire in C is because whatever B is doing, they have this portion of it. They have this portion of it. So it is in that 2025, you can say, oh, out of whatever percentage B is acquiring in C, A owns 57% of it. A owns 57% of it. The third thing, which is the last but not the least note, is that what is the purchase consideration. Whatever purchase consideration the parent is paying to acquire the subsidiary, whatever purchase consideration the subsidiary is paying to acquire the subsidiary is to be apportioned or shared between the parent and the non-controlling interest in the subsidiary. What do I mean by that? We have said that where once A acquires B, we have two parties in B, parent and what? Non-controlling interest. So whatever B is doing, we believe with these two people that are doing it, and they will be sharing it based on their percentage of interest or percentage of holding in this B. Now, whatever purchase consideration B is now paying to acquire C will be shared between these two people in their percentage of holding. Sorry, 1 minute. Okay, sorry for the okay, sorry about the interruption. So I said whatever purchase consideration B is paying to acquire C will be shared or distributed between the parent and the non-controlling interest. In what order? In the based on their based on their percentage of holding in the subsidiary. Now, how do we then treat it? The parent portion is what we'll be using to calculate the goodwill the parent will have in C. We'll use the parent portion to calculate the goodwill the parent will be having in C. While the NCI portion is used to reduce value of NCI, at the date of consolidation. It is used to reduce value of NCI at the date of what? At the date of consolidation. And that is why we have this. So if we want to calculate goodwill in the subsidiary, we'll now say what is the parent percentage of holding in the subsidiary multiplied by the purchase consideration of the subsidiary in the subsidiary. Then we will add the NCI based on whatever method we are using to measure NCI. Is it proportionate share or fair value? Then we'll then less fair value of the net asset of the subsidiary, and we'll get the parent goodwill in the subsidiary. That is to show that we are not saying because it is a subsidiary, the parent will now be accounting for the portion they don't own in the subsidiary. You remember that the portion we said they own in the subsidiary is the portion they hold in the subsidiary multiplied by the portion the subsidiary hold in the subsidiary. So also the goodwill will be restricted to that portion. And when calculating NCI at the date of consolidation, when we bring the value of NCI in the subsidiary and the value they have in the subsidiary, we will add their share of post-acquisition earnings. Then we'll now less the purchase consideration NCI in the subsidiary would have paid for what? For the acquisition of the subsidiary. But when we get to question, we'll be able to dissect it more. Do we have any question before we go to practice question? Any question before we go to practice question?
Yes,
sir. Hello, sir.
I can hear you.
Yes, this I didn't quite get this last part.
That's why I said when we put figures to all of these things, it will be more clear. What I've said there is that the purchase consideration the subsidiary is paying for the acquisition of the subsidiary will be used. The consideration will be apportioned between the two parties that own the subsidiary, which is parent and NCI. So we now say, how do we now treat it? While the parent will use their own portion of the purchase consideration for the calculation of the goodwill they had in the subsidiary, NCI portion will be deducted. NCI portion will be deducted from the value of NCI at the date of consolidation. Is it clear? Is it clear? When we put it, I will be able to elaborate more. I'll be able to elaborate more on it.
But I have a question in this regard.
Go on.
The situation we are creating, the scenario we are creating here, does it mean that the acquisition of the subsidiary is acquired after A had already acquired B, or
regardless
before?
Regardless of when the acquisition occurred, we'll still be using the same treatment. Yeah.
Okay, that's fine. Thank you.
So the purchase consideration will be apportioned between the subsidiary and the subsidiary, or
between the parent and the non-controlling interest of the subsidiary.
Okay. Thank you.
Hello, good evening. Hello.
I can hear you.
Oh, good evening,
I
sir.
can hear you.
All right, good evening. Please, my question is, I want to just confirm for this purchase what do you call it, date of acquisition. Now, among these dates that are here, which one is appropriate for us to make use of on the day, whatever we are considering the sub?
The scenario in the question is what will determine the appropriate date of acquisition. Like I have said, if the subsidiary acquires the sub-subsidiary before the parent acquires the subsidiary, then the date the parent acquired the subsidiary is what will be taken as the date the parent also acquired the sub-subsidiary. And if the parent acquired the subsidiary on the same day the subsidiary is acquiring the sub-subsidiary, then the same date of acquisition will still apply to both of them. But if the subsidiary should acquire the sub-subsidiary after the parent had acquired the subsidiary, then whatever date the subsidiary acquires the sub-subsidiary is what will be taken as the date of acquisition for the parent in the sub-subsidiary. Like I said, all of these things might be looking confusing because of how we are interchanging the words. But when we put it into figures now, it will be much clearer.
Thank you.
Okay, so please, can someone take us to question 1?
The following is a summarized statement of financial position of husband PLC, wife PLC, and son PLC as at 30th September 20X9. All figures are assumed to be correct. Yeah, please scroll down. Relevant notes. Husband PLC purchased 55% of the equity shares of wife PLC on January 1, 20X7, when the retained earnings of wife PLC were $88. No, it's $8 million. Wife PLC acquired 80% of the equity shares of Son PLC on 30th June 2088, when the retained earnings of Son PLC stood at $70.5 million. It is the policy of the group to measure the non-controlling interest at acquisition using the proportionate of net asset basis. Husband supplies a component to wife PLC and Son PLC at cost plus markup of 25% on 30th September 20X9. The inventories of wife PLC included $3.8 million, and the inventories of Son PLC included $4 in respect of these components. The trade receivables of husband PLC showed an amount of $2 million receivable from wife PLC, while the trade payable of wife PLC showed an amount payable to husband PLC of $1.5 million. The difference being as a result check sent by wife PLC on 28 September, which was not received by husband PLC until 2nd of October 20X9. Required, prepare the consolidated statement of financial position for husband group as at 30th September 20X9.
Okay, thank you very much for that. We'll start with the solution now.
Crazy, I'm not hearing, no. I don't know if I'm the only one.
I can't hear him too.
Okay, hope he's not muted though.
No, I'm not muted. Can you hear me now?
Yes, I can hear you now.
Okay, good. So we have husband, wife, and son. Husband, wife, and son. And from what we have read, husband acquired wife, then wife acquired son. So we'll take it one after the other. Husband acquired wife, 55%. So NCI in wife is 45%. And then wife in turn acquired son, 80%. So what do we say? We would say, first thing first, what is the date of acquisition? The date of acquisition in wife is what? They were acquired on 1st January 20x7. Date of acquisition of son. What date did husband acquire their interest in son? The day they acquire their interest in son will be 30th June 20x8. And it is 30th June 20x8 because wife acquisition of son occurred after husband has acquired wife. We cannot now say that husband acquired their interest in son as at 1st January 20x7 because as at that time, they have nothing to do with son. What only made them to have interest in son was because they own wife, who in turn own what? Son. That's what gave them interest. And the day that interest occurred was what? On 1st of was on 30th June 20x8. And on what date are we consolidating all of this? We are consolidating as at 30th September 20x9. Now, the next thing that is also important is what is the effective interest in son. Effective interest in son will be what? 55% of 80%, because whatever wife does, they own what? They own 55% of it. So what do we have?
45%. Where is the 45% coming?
44%.
I'm coming, please. You say 44%, Abby?
Yes.
Okay. 45% was coming from, if out of 100% of wife, the husband has acquired 55%. 55 minus 100 will be what? Are you following, ma?
45, yes. Thank you.
Yeah, so that's how we got the 45%. Now, having calculated the effective interest in son to be 44%, we can then proceed to the next adjustment. And what will be the adjustment? The adjustment will be to now start looking at each and every additional information before we go to goal adjustment itself. Okay. So we dealt with the first two additional information. When we need it, we come back to it again. The next one we have is that it is the policy of the group to measure NCI at acquisition using proportionate of net asset basis. Okay, good for us. The next one we have is that what? They said husband supply a component to wife and son at cost plus markup. On 30th September, inventories of wife and son include this in respect of the components. Since they are selling the components to them at a profit and they still have that profit, they still have that component as part of their inventory. The group rule is that what? We recognize whatever profit that is on those items that they sold. Reason being that what? Reason being that the sale between entities in the same group is still seen as the group being with the owner. And IS2 asks us to measure inventory at lower of cost and net realizable value. In this case, the cost will be cost to husband, not cost to wife or son. So we calculate unrealized profit on inventory. So we first have husband to wife, and the unrealized profit will be, since they said it is markup at 25%, but what we have is the sales value, because what wife would have recorded in their own books is the value at which they buy from husband, and the value of them buying from husband is sales value to husband. So we have to convert the markup to margin, and by converting it, it means it will become 25 over 125. Don't forget, markup to margin is profit over cost plus profits. So we say 25 over 125 multiplied by 3.8 million, multiplied by 3.8 million. What do we have? What do we have?
760 million.
760,000. So can just call that 760. I like to put the double entry beside each and every of my adjustments, so that when anything is going wrong, I can easily know, oh, this is what I'm doing wrong. Okay, I'll say debit what? Retained earnings of who? Of husband, because husband was the one that recognized the profit. Now that we are saying the profit is yet to be realized, they have to cancel it out. Then credit what? Credit inventory. The inventory they have recognized. You know, the essence of calculating unrealized profit is to reduce the inventory back to its cost, which is what a credit to the inventory we do. Then we have husband to son. That will be what? 25 over 125 multiplied by 4 million. So that will give us what? I think that should be 8 million. Am I right? Hello? So debit
8
retained
million.
earnings
8,000,
of
rather.
all,
800,000.
this one is still the one selling. Then we'll credit inventory. We'll credit inventory. Please pardon me. I want to. This book is already, something is wrong. There is a bug on the item, so I want to reopen, please. Please confirm you can see my screen.
Yes, sir, we can
Yes.
see it.
Both the workings page and the material page, Abi.
I can only see the
Just the
I'm
material
not
page.
question.
seeing the working. Oh.
Comment, please.
Only the question is showing.
Is it okay now?
Yes, it's okay.
Yes, sir.
All right.
Sir, please, I
So
just have a question on this unrealized profit.
go on with your
Just in,
question.
sir, so the concept of this unrealized profit, are we trying to remove the profit element from the inventory? I want to just
Yes,
get the concept. Okay, that's why we are calculating. We are trying to calculate for the unrealized profit.
yes. So let's assume I have two shops with two
Okay.
different store manager.
Okay.
Now, when they want to buy, especially for Igbo people, when you want to buy something from them and you ask in this shop, they say they will not tell you they don't have it. Rather, what will
Yeah.
they do? Even if they don't have it, it's either they go to another to their other shop to get the item, or they meet any of their friends or colleagues selling the same item and sell to you. When they
Yeah.
sell to you, they will go back to meet that person. I really don't know how they do it, but it's possible that the person would have sold to them at a profit also, and they will pay the person, but maybe not as high as what you paid. Now, if at the end of the day, let's assume after they come to collect the inventory, the goods from you that they want to sell to a customer, the customer ended up not buying. Will they pay the profit you are supposed to have made on that goods?
No, they won't.
They will rather return it at its cost
But
price. So
yes.
just like that here, what the husband has sold to wife and son, even though they have sold it at profit, that profit to the group is yet to be realized until they are able to sell it to a third party. Now
Yeah.
that at the date of clearing account, they have not been able to sell it to a third party. What do? Would they
They return
recognize
it.
the profit? Is
Okay.
it clear?
Thank you. Thank you. It's clear. Thank you, sir.
You're welcome. Okay, we move to the next thing. Note 4. They said the trade receivables of husband PLC showed an amount of 2 million receivable from wife, while the trade payables of wife showed an amount payable to husband of 1.5 million. That's strange. If wife is buying from husband, then whatever husband is having as receivable should be what wife will also be having as payable. I mean, to each other, not their entire payable and receivable. If
Yes.
you are, take for instance now this class. If I say, oh, the last topic I took is subsidiary vertical group, it will be wrong for someone to say, no, the last topic you did was fellow subsidiary, because what I'm saying I taught is what you are saying you learned. So we should actually be on the same page. If we are not now on the same page, then something is wrong somewhere. What do we then do? We have to look for what is causing the difference and reconcile. Now, they now told us the difference was because wife sent a check to husband on 28th September, but husband did not receive it on the 2nd of October. So, when wife was sending the check, they would have recorded that they have made payment. So they would have used that payment they made to reduce their payable. Meanwhile, husband is there to receive money. So husband will still be carrying what? Husband will still be carrying the whole amount that they are still expecting to receive it. So that 500, that check, what check would they have sent now? The difference, which is 500,000. Is that not it? We refer to it as cash in, transit. We refer to it as cash in transit. So the cash in transit will be 2 million minus 1.5 million. That will be 500,000. So what do we do to it? We will assume husband has received it. If husband has received it, they will be debiting their bank and crediting what? Receivables. They will be debiting their bank and crediting receivables to recognize the receipt. Now, meanwhile, what husband shows that wife is owing them and wife is showing that husband is owing them, the group who says we should what? They recognize it, because why will you be saying you are owing each other when you are the same, when you are seen as one? So we call that intra-group current account. Intra-group current account. How much? What they will be owing each other after settlement of this 500 now will be 1.5 million. 1.5 million. And that 1.5 million, which they are owing each other, what do? We'll debit it to our payables account so that I can cancel it from wife's payables. Then we'll credit it to receivables so that I can also what? You can also cancel it from husband receivable. Does it make sense? Does it make
Yes, sir.
sense?
I thought this the cash in transit is the 500 that didn't reflect in the wife. I thought it's going to balance it out and make it to 2 million.
The 500 has already been paid. Husband is here to record, but wife has recorded it. So it will go and reduce what husband is having as receivable. Are you getting it? Then having reduced it, they will now both be having 1.5, 1.5.
Yes.
That is when we will now cancel out the 1.5 by debiting payables and crediting receivables. Is it clear?
Yes.
Okay. Having done that, we've done the additional information. The next thing is we now go to our usual group account. In our usual group accounts, what do we go for first? We go for the net asset summary. We go for the net asset summary. I'm with you.
Yeah. So the entry, the posting rather for cash in transit, is it on the wife's account?
Is on the husband's account.
Okay. How
Because
about
the husband that we are assuming they have received the money. But for the intra-group, both of them are recording. While wife will debit their own payable, husband will be crediting their own receivable.
Okay, please, can you put a husband in bracket by the bank? So that the way you did for
what we are preparing is what is it called? Group accounts, consolidated accounts. So regardless of who we are debiting or crediting, why we have to show that of retained earnings separately is because retained earnings of the subsidiary will be shared between parent and non-controlling interest, but that of parent is only affecting parent. So at any point we are mentioning retained earnings, we have to specify whose retained earnings are we referring to. Is it clear? Is it clear?
Yes, sir. Okay.
Please, can you just recap on the retained earnings again?
I said ideally, every adjustment we are doing here is going to consolidated accounts. So it doesn't matter whose account it is affecting. But we are putting notation to that of retained earnings because their retained earnings statement is different. Retained earnings of the subsidiary will be shared between parents and non-controlling interest, but that of parents is for parents only. So whatever affects retained earnings of parents, we cannot go and use it to affect subsidiary. And whatever affects retained earnings of subsidiary, we cannot go and affect it or show it in the parent zone. If you look very well, the retained earnings of the subsidiary is part of what we'll calculate in this net asset summary, and we'll share it. But that of parents, we are not sharing it. So that's why we need to denote when it is affecting retained earnings, whose retained earnings is it affecting? Is it clear?
Yes, thank you.
You're welcome. So net asset summary, we will come to the equity items. Ordinary share capital. For wife, their ordinary share capital is 150,000. 150,000. So post-acquisition earnings will be made. Because except otherwise stated, we assume whatever retained earning, whatever share capital they have at the date of acquisition, at the date of consolidation, is still what they have at the date of acquisition. So this one too will be 100,000. 100,000 post-acquisition earnings will be made. Then share premium. Share premium will have what? 80,000 at the date of acquisition, same on the date of consolidation. 50,000 on the date of acquisition, 50,000 on the date of consolidation. Then retained earnings. Retained earnings is usually not the same thing. If you look at note 1, we were told that the retained earnings at the date of acquisition was what? Was 88 million. So I'll come here and say 88 million. Why that of Sun was what? 70.5 million at the date of acquisition. 70.5 million. Then at the date of consolidation, it is 295,500. Then 183,600. 183,600. So please give me this difference. And if you look at all of our workings, none of it is affecting the retained earnings of any of the subsidiaries. So we can
For
get
the
the
why
summation. Huh?
the PA the PAE for the post acquisition earning for the wife is 207,500. For the retained earning, why for the son is 113,100.
Thank you, Scholar Candy. Can I have the total of orders?
Wife at DO is 318 318,000.
318,000. Okay.
Yes, sir.
So wife at DOC is
So that this should be
525 500.
500.
Son at DOC
This should be
said
220
333,
500. This should be
333,
333
333,000.
600. Am I right?
You are right.
Immediately I'm done with the class. Not even tomorrow. I'll share it with you this night. So if you want to write, you can doc for me. at your own leisure. But please, the supplying figure is very necessary at this point. Okay. Having done that, our next group adjustment will what? Goodwill, which is one of the big three. So goodwill for wife and goodwill for son. So to calculate goodwill, as usual, purchase consideration. And what is the purchase consideration? As we are not told how much they paid in acquiring the stake they acquired, we go to their SOFP. So husband paid 280,900 to acquire wife. So say 280,900. But what husband did not acquire son, rather it was wife that acquired son. And we have said the purchase consideration wife paid to acquire son will be apportioned based on their percentage of interest in wife. So we'll say purchase consideration for son will be they hold 55% interest in wife. So 55% of the 270,000 wife paid to acquire son is what they will be responsible for. 55% of 270. That's 148
148,500.
148 500. Then we go to NCI at proportionate share. If NCI is at proportionate share, then what would be NCI? For wife, NCI will be 45%. That is the percentage NCI hold. 45% of the net asset at the date of acquisition, 318,000. While for son, we'll look at if the effective interest in son is 44%, then that means the non-controlling interest in son will be what? 56%. It will be 56%. So 56% of the net asset on the date of acquisition, which is 220,500. What do we have?
For the
143
wife is
100.
143 100.
I might be missing me. I know I fancy my sleep and I would not want you guys to take it away from me. So this is 123 400.
80. No,
480.
480.
Yeah, it's
Sir,
480. Don't
please,
mind
sir,
me.
sir, please, how do you get the
I'm with you.
56%? How do you arrive at the 56%?
If effective interest of husband in son is 44%, what will be the NCI? NCI will be 100 minus 44%, and that will be 56%. That's NCI in son. Is it clear?
Okay, it's clear, thank you.
Okay. The next thing we have is what? We left fair value of net assets. I can hear you.
Okay, sir. Please, using these figures now that the 56% of the time, can you like explain what you explained earlier concerning the stuff you just did now? You said when you're solving that you will understand better.
We are not done
So
yet.
can you just explain again?
Hello. We are not done yet. When we are done, I will take it again. So if we
Okay, sir.
less fair value of net assets, what do we then have?
106,000.
106,000. Then for son, what do we have?
61,480.
61,480. Now we were not told of any impairment. So
51.
51.
Yes.
We were not told of any impairment. That's why we will not bother ourselves with it. So we go to note 8, which is NCI. And to calculate the NCI, we use what? Value at acquisition. And as usual, our value at acquisition will take. I can hear you.
You said we'll not bother with something. I didn't get that, sir.
I say they did not give us information about impairment. So we cannot calculate, we don't have information about impairment. So that means there will be no impairment.
Okay.
We leave impairment out of it. NCI at acquisition, based on what we calculated in goodwill, 143,100 and 123,480. Then we bring their share of post-acquisition earnings. For wife, they will take 45% of what? Of the 207,500 that they have made after they were acquired. While son, they will take 56% of the 113,100 that was made after they were acquired. What would that give us?
93,375 for the wife.
93
375.
3 or 675.
375.
Okay, this is so we then less what? We then less share of purchase consideration. Share of the purchase consideration in son. Share of purchase consideration in son. Let me do it this way. So what do we have as the summation?
Yeah. 236,475.
Then we then less share of purchase consideration, less their share of purchase consideration in Sun PLC. So what they would have taken, they would have bond 45% of the 270,000.
Sorry.
Well,
This is supposed to be 816, not 916.
okay, so 45% of the remuneration will be what? 121,500 for the subsidiary. That will give us what?
114,975.
114,975. So that was what I was explaining. That the 270,000 that was paid to acquire wife, why will debit the parents' portion to the goodwill account? Will be debiting the NCI portion to their own NCI account. So we will take the parents' portion in calculating goodwill. We'll take out the NCI portion for calculation of NCI. Is it clear?
Yes,
Is it
sir.
clear?
Can you please
Yes.
come
Then we
back
go
on this
to
purchase? Can you please come back on this let's share of purchase
you guys
consideration and
paying.
so
I'm repeating the same thing over and over now. They paid 270,000 to acquire the sub-subsidiary. Take the parents' portion based on the percentage of interest they have in the wife to calculate goodwill. Then take that of the NCI, deduct it from their NCI value, from the subsidiary NCI value at the end of the year.
noted. Noted.
So to calculate consolidated retained earnings, we'll have husband's retained earnings. And the husband retained earnings is what? 720, 800. Then we bring share of post-acquisition earnings. And for that, we have for wife, they will take 55% of what? Of 207, 500. While for son, they will take 44% because that's the percentage they have in it. 44% of what? Of 113,100. What would that give us?
For the wife, 114,125.
114,125. Okay. For the son,
Then
49,764.
49,764. Okay. Having done that for our share of post-acquisition earnings, we'll then look at was there any adjustment that affect retained earnings of the parent. Yes, we have unrealized profit of 760 and 860. So I can come here and say unrealized profit on inventory. 760 plus 800, that is 1,560. And since I said debit retained earnings, it means we want to deduct it from retained earnings. So we put it in bracket. Aside that, we don't have any other transaction. We don't have any other adjustment to this. So we do summation of this, and that will give us how much?
883,129.
883,129. So we can then proceed to consolidated statement of financial position. Consolidated statement of financial position as at 30 September 20x9. Have dollar quoted in thousands. Assets. PPE. What do we have? We have 800, 600 plus 420, 800 plus 300, 750. And if we look at all of the adjustment we have here, none of it is affecting our PPE. So we close that. So instead of investment in wife and son, we are already consolidating. So those ones will not come. In place of that, we'll bring the goodwill. We'll bring the goodwill. And the goodwill is what? 106,000, then 51,480. 106,000 plus 51,480. Okay, the next will now be what? The current assets. The current assets. And what are the current assets? We have 1,450,000 plus 369,100. Then after the 369,100, we have 499,100. However, from here we have series of adjustments. Unrealized profit 760 and 800 is affecting inventory, and inventory is part of our current assets. So we have to take it out from it. The next one is what? The next one is receivable should be credited with 500 and it should also be credited with 15. So if an asset is being credited, it means we are deducting minus 500 minus 1,500. I don't think we have any other adjustment. So what will be the figures, please?
For PP, 1,522,115.
1 million.
522,150. For
Okay.
goodwill, 157,480.
157,480. So for our equity and liability, as usual, we don't consolidate equity items. So ordinary shares, we bring that of the parents, 200,000. Share premium, share premium. Share premium, we have what? 410,000. Then we'll bring consolidated retained earnings instead of retained earnings. Retained earnings. Consolidated retained earnings is 883,129. So the summation of all this will give us the shareholders fund. Then NCI. And what's the NCI? 114,975. 114,975 plus. Okay. Sorry, the other one is 186,816. 186,816. That's for NCI. Please, when you have the figure, let me know. And if you have any question, you can call my attention to it, please. Non-current liability 680,100 plus 209,100 plus 180,350. Okay. No adjustment to non-current liability. So we move to current liabilities. Current liabilities, we have 520,600 plus 325,300 plus 285,900. Check our workings. Yes, there is adjustment. We said payable should be what? Debited with 15. Mind you, we haven't done the debit entry of 500 that we have here. I will fix it. So since that one is also relating to current assets, I will just add it here plus 500. For the payable, we are deducting it because we say debit payable. So deduct my 15. What do we have? Okay, so what do we have? Please, if you have the figure, just call for me, please.
So please, the
01. I'm with you.
760,000. These 760,800, are they like in thousands?
Every figure here are in thousands.
Okay.
Current asset is 2,315,140. 140.
2,315,140. Total assets, please. Oh yeah, oh. Ṣé àwọn tó ní calculator ti lọ sùn ni?
That's 3,994,777.
Èwo ń bẹ̀ ní kí
Total
ni o tún
assets.
ti bẹ̀rẹ̀?
Total assets now. It's not 3 million.
Total assets 3 million
994
994
770.
770. So current liability is 1,130,300.
Shareholders fund is 1,493,129.
Please, what do we have as the total?
Three million 994,770.
3,994,770. That is that on that. Any question? Any question?
No question.
No, sir. Okay.
Okay, let's see if we can do one more question before we call it a time tonight. Okay. Question 2 will take us quite a time because the additional information there are a bit much. So maybe we do 3 this night, can practice 2. Then in our next meeting, we can quickly look at 2 before we go into another topic. Who is reading for us?
Question 3. Bayonet, a public limited company with 2 subsidiaries. The statement of financial position of the 3 companies as at 31st December 2009 as follows. All figures have been correct. Simply scroll up. I must see.
Why, you don't have your own phone?
It's okay. Number 1. Bayonet, a public limited
It's
company,
okay.
purchased yeah, gone up to purchased 6 million shares in risk a public limited company On 1st January 2025 for $10 million. Ripple had purchased 4 million shares in Peachtree, the public limited company, for $9 million on 31st December 2018, when its retained earnings stood at $5 million. The balance on retained earnings of the acquired company were $8 million and $6.5 million respectively at 1st January 2025. The fair value of the identifiable assets and liability of Ripple and Peaceful was equivalent to their book value at the acquisition date, with the exception of the following relating to Ripple. 2. Property having a carrying amount of $5 million, depreciable components $3 million, had an estimated market value of $8 million, depreciable components $5 million. The estimated future economic life of the depreciable components was 10 years, and these estimates remain valid. Plants and equipment having a carrying amount of $11 million had an estimated market value of $13 million. The estimated future economic life of the plants and equipment was 10 years, and these estimates remain valid. Waffle had not disposed of any of these plants and equipment since 1 January 2025. Good policy is to value NCI at fair value at acquisition. The fair value of the NCI in which was calculated as $3,230,000 on 1st January 2025. The fair value of the 40% NCI in Bristol on 1 January 2025 was $4.6 million. Impairment tests in current and previous years review impairment losses of 100,000 and 200,000 respectively required. Please let me spell. I cannot say again.
Prepare the consolidated statement of financial position of Bionet as at 31st December 20x9.
Okay.
Go
Thank you
ahead.
both parties. 1 minute. Okay. We have all of those information about Bionet and its subsidiaries. So, as usual, the first thing we'll do is to draw the group structure. Bayonet, acquiring rifle. The acquire rifle, we don't even know what percentage they've acquired the rifle. But we were told that rifle also acquired pistol. Now, our first task in this is to determine what percentage has each of them acquired in each other. So, I would say 2 percentage of holding. Bayonet in rifle, they said they acquire 6 million shares. But how many shares does rifle have? As will come here. They said their share capital is 4 million because the figures are quoted in what? In thousands. So if the share capital is 4 million and the nominal value is 50 cents, I would say $4 million divided by 50 cents. 50 cents is 0.5. All of this multiplied by 100, and that will give us what? Then rifle in pistol,
25%.
75%. Rifle acquired 4 million shares in pistol. 4 million shares divided by pistol has 2.5 million share value, 2.5 million divided by 50 cents also multiplied by 100. What do we have?
80%.
80%. Okay.
How come I'm not getting the figure? That's 6 million.
NCI in rifle will be 25%. Date of acquisition for rifle and date of acquisition for pistol, then date of consolidation. They acquired their shares in rifle on 1 January 20X5, while rifle acquired their interest in pistol since 31 December 20X2. But when will the parent gain control of pistol? It is as at when they are getting control of rifle also. So we'll say the date of acquisition here is also what? January 1, 20X5. Are we getting it?
Are you still writing, or I can't see. What I can see last was that 80%. I can't see what you're saying.
Maybe your
Is your
network.
network?
Others should please confirm they can see what I'm writing.
You can see what you're writing,
I
but I
can
don't know
see.
how you punch the
I
calculator
see what
to
you
get
are writing.
75%.
Let him look
You
up.
don't
Let
know how
him
we
look
do
up.
it?
It's like he's looking down.
I keep punching the calculator. I'm not getting 75% and 80%.
Okay. So square 6 divided by open bracket 4 divided by 0.5. Close the bracket and press equals to. What did you get? Hello?
Yeah, yeah, I've gotten it. Thank you.
Welcome. Are we all on the same page now?
Yes, sir.
Hello? Okay, if we say we are all on the same page, the next thing will be for us to calculate effective interest in piece 2. Effective interest in piece 2 will be 75% of 80%, and that will give us how much?
60%.
60%. So NCI in this will be what? 40%.
40%.
Then we move to note 4. Here we were told that what? The balances on their retained earnings they gave us, the fair value of the identifiable is equivalent except for this. That exception, what do we do to it? They said at the date of acquisition of rifle, they had property that has a carrying amount of 5 million, out of which 3 million is depreciable. But that property had a market value of 8 million. And the future economic life is of the depreciable component now is 10 years. What do we do to this? We have said that for the purpose of consolidation, assets and liabilities at the date of acquisition will be carried at their fair value. That means we have to calculate fair value adjustments. And what is the adjustment? The 8 million market value minus the 5 million market value. That will give us what? 3 million. And the 3 million, the double entry for it will be to debit PPE because it's an addition, is an increase in value of our PPE, and credit revaluation surplus. However, because the asset is depreciable, when we look at date of acquisition to the date of consolidation, it's already like 5 years. 5 years. So they would have been depreciating the asset at its book value. But now that we are recognizing the asset's fair value, we have to depreciate it also. We call that under depreciation. Because they've been depreciating the asset at its book value, which is lower than its fair value, they would have been under depreciating the asset. So if the depreciable components had a market value of 5 million, but had a book value of what? 3 million, then it means the revaluation surplus attributable to the depreciable component is 2 million. That is what we'll now divide by the useful life, which is 10 years, multiplied by our post-acquisition period. 20x5, January 20x5 to December 20x9. That is 5 years. And that will give us how much?
1,000.
1,000. And that 1,000, what do we do? We'll debit it to retained earnings of rifle because it was rifle that under depreciated their assets. Then we'll credit it to where? PPE. PPE. You know, since we recognize the entire fair value surplus, it's good for us to also recognize the depreciation so that it can bring the asset down to its value. Then we go to note 5.
Sir, please, sir, I have a question.
Go
So I don't
on.
know if you can explain this under depreciation. I'm not really getting it. I just need a clarification on it.
When the asset,
Okay.
based on its book value, that asset
Yes.
will be carried at 5 million.
Okay, yes.
Out of the 5 million, 3 million is depreciable. So if they divide that by the useful life of 10 years, what they will be charging every year will be 300,000. Is that not it?
Yes.
But we are saying the assets should have been carried at 8 million, out of which 5 million is depreciable, meaning the depreciation should have been 0.5 million. That's 500,000. I mean,
Yes.
now they've done this over a 5-year period, but they are supposed to do this. What do we then do? Instead, because we don't have the figure easily like this and say 0.2 times 5, which would have given us 1 million, I'll just say, okay, if it's supposed to be 5, but they will have charged 3, then divided by the useful life, multiplied by the 5 years, it will still give me the same 1 million. Is it clear?
So, yes, sir. Yes, sir.
Okay. They also said a plant and equipment had a, let me put it here, property.
Okay, please, can you clean this other example you wrote now?
Okay, ma.
Thank you. So when we are copying.
Please, can I want to clarify this number of years and the life of the depreciation, the depreciation component of 10 years, 5 years and the 10
Yes.
years. How do you come about it, please? I'm not getting that part, please.
Welcome back to class, sir. Yeah, we were told that the asset, the depreciable component was 10 years. I mean, the estimated future economic life of the depreciable component was 10 years, and the estimate remains valid. Is that clear?
Yes, the 5 years, please.
So, if the asset, you know, all of this information they are giving us, I mean, for this particular additional information, it was at what date? Is it date of acquisition or date of consolidation?
Date of acquisition.
So between date of acquisition, that is date of acquisition of rifle, because that information is relating to rifle. Between date of acquisition to date of consolidation, how many years do we have?
The 5 years.
Subhanahu wa Bika.
Yes, thank you.
You are welcome. Okay. For the plant and equipment, it had a carrying amount of 11 million, but market value of 13 million. So that's also another fair value adjustment. 13 million minus 11 million. That is 2 million. What do? We debit that to PPE also, and we credit it to a revaluation surplus. That is for plants and equipment. So it is also a depreciable asset. They say the useful life is 10 years, and with the useful life is 10 years, it means it has been under depreciated because they were depreciating at book value. So the 2,000, which is the surplus, divided by 10 years, multiplied by 5 years, is how much? That should be 1,000 also. We debit that to retained earnings of rifle and credit it to PPE because it was still rifle that owns it. Okay. Having done that, they said the group policy is to measure NCI at fair value, and they gave us the fair value of the non-controlling interest in rifle calculated to be 3,230,000, while the fair value of 40%. Remember, if you see, well, how much did we calculate NCI to be after effective interest? 40%. They have calculated it earlier. They say the fair value of 40% interest in P2 on that day, on 1st of January 20X5, is what? Is 4.6 million. So as for the impairment, we'll only need impairment after calculating goodwill. So what do we need to do? We go to calculating net assets summary. Net assets summary. So we have rifle and we have pistol. Date of acquisition, date of consolidation, PAE. Date of acquisition, date of consolidation, post acquisition. So I'll go to the equity items. We have ordinary share capital. For rifle, it is 4,000. For pistol, it is 2,500. Okay. Retained earnings. Our retained earnings at the date of consolidation is 2,400, then 16,300. But at the date of acquisition, for that of rifle, they said the balance on the retained earnings was 8 million. Now, one of the reasons why determining the date of acquisition for pistol is important is that since our date of acquisition is 1st January 20x5, is the retained earnings of 1st January 20x5 we'll be looking for. You know, they gave us retained earnings on 31 December 20x2 to be 5 million. We don't use that. It is the retained earnings on the date control was actually gotten, which is what? 6.5 million we'll be using. So we have 6.5 million. Okay. So please help me calculate the post acquisition earnings. So that's what we have under equity, but we have some adjustment that affect our equity here. We have fair value adjustment. Fair value adjustment, which is a surplus. So we can actually add both together. One was 3,000, the other was 2,000. That is 5,000. And since the asset has not been sold, we'll say we still have the fair value adjustment at the end of the year. However, the under depreciation on it, under depreciation will be at the date of consolidation because we did not depreciate the assets on the date of acquisition. That is what? 2,000. So with this now, I think we are done with everything we have here. So summation.
The PAE for Wifood is 10.4. I'm sorry. The retained earnings for 12.4. 12. Why the everything is not 10.4?
This is 17,000. This is 27,400. This is 9,800. This is 9,000. This is 18,800. Note 7. Note 7, we'll be looking at goodwill. What do you say? In calculating goodwill, we have rifle and pistol. So the purchase consideration for rifle, we were told they were acquired for 10 million. For pistol, it was acquired for 9 million. And of the 9 million, rifle will be liable for what? 75% of the 9 million. So 75% of 9 million is what?
6,750.
6,750. Then we bring NCI. Since they say NCI should be as proportion at fair value, we are giving the fair value to be what? For rifle, it is 3,230,000. While for pistol, it is what? 4,600,000. Then we less fair value of net assets. Fair value of net assets for rifle is how much? 17,000. While that of pistol is what? 9,000. So that means we'll have goodwill for the positive figure or gain on bargain purchase for the negative figure. So this will give us what? 3,770 negative. That's the gain on bargain purchase. Why this will give us what?
2,350.
2,350 goodwill. So that means the impairment they were referring to is impairment of the goodwill they have in pistol. So we say less impairment. We are lessing the total impairment. There has been current year 400, previous year 200. That's a total of what? 600,000 impairment. So what will be the balance?
Please, where is the impairment figure coming from?
Welcome back, man.
I've seen it.
Can I proceed?
Yes.
Please explain, sir. I would not understand, please.
That's 1,750.
We don't understand what?
The impairment, the impairment. The figure you got there, 400 minus 200.
You don't understand or you don't know where I picked the figure from?
Not
I don't
five.
understand 400 minus 200. I don't.
Do you know where I picked the figure from?
No, sir, I don't know how you come about 400,000 plus. Okay, that's 600. Okay. And where you pick the figure from? Sorry.
Have you checked the question? Note 5.
Okay, okay, sir. Thank you.
Sir, concerning the impairment, are we adding the whole 600 to pistol because you had a loss on goodwill for rifle? Hello, sir.
We don't have loss for rifle.
Like gain on bargain purchase, like because they said that we have to share the impairment respectively. That is 400 should go for rifle and 200 should go for pistol.
No, they did not say share out. Read the question again. What did they say?
It's a impairment test in current and previous year reviews impairment losses of 400 and 200,000 respectively.
And now, so what they mean is that when they tested for impairment, it is the entity that has goodwill that can have impairment. So
Okay.
it's only pistol that has goodwill. So if it's goodwill, the impairment would have only been for pistol.
Okay.
Now, when they tested it in the current year, impairment loss was 400. When they tested it in previous year, it was 200. But because I am consolidating statement of financial position, I will not bother. I just need the total impairment.
Okay, thank
I
you.
think I can do the SOPL now. Then the 400 is what I'll go and use in my SOPL. Is it clear?
Yes, sir.
That is that. So I will have 1750. Having done that, I can go to note 8, NCI. The value at acquisition is what? For rifle, it is 3230, while for pistol, it is 4006. Then we'll bring share of post-acquisition earnings. Rifle will take 25% of 10,400, while pistol will take 40% of what? 9,800. Figure.
26 for
Which one?
rifle. The share of PAE 26.
What? Rifle is what?
2,600.
2,600. Okay. What about pistol?
3,920.
3,920. Then the summation will be what? So then let's share of purchase consideration. Let's share of purchase consideration. That will be share of purchase consideration will be share of purchase consideration will be they are only responsible for 25% out of the 9 million that they use in acquiring the subsidiary. And that will give us how much? 2,250,000. Are we? So carrying amount to be what?
3,580.
Huh?
3,580.
3,580. Okay. Having done that, we can now then do the consolidated indebtedness.
Sorry,
So
please,
for
I didn't get the share of purchase consideration. Sorry.
huh?
So I didn't get your explanation on the share of purchase consideration.
For subsidiary is acquired by two people, which is the parent and the non-controlling interest subsidiary. So while the parent portion is used to calculate goodwill, the SPI portion is used to reduce their value in the business. Is it clear?
Yes, thank you.
Okay, you're welcome. So for our consolidated retained earnings, say Bayonet retained earnings 25,500. Then what else? share of post-acquisition earnings. To share of post-acquisition earnings, we'll have what? We would have for rifle, he will share 75% of 10,400. For pistol, they will share 60% of 9,800. Okay, we then look out for, is there any adjustment that would have affected this? The retained earnings is not affecting no adjustment is affecting parents. However, I've made a fundamental mistake. There was impairment on on goodwill, and then NCI had to share part of that impairment. So, permit me to update this. I would say because it's only pistol that has impairment, I would say let's share of impairment. Their share of impairment would have been what? 40% of the 600,000. And that would be what? 240. So if we take out the 240 from their value, what will it be for us?
Eight two eight zero.
8280. Okay, so what's their share of profit? We then say after share of profit, we bring the gain on bargain purchase. Okay, yeah, gain on bargain purchase was 3770. As an addition to them, this one will be 5880. To be candid, me pressing calculator for myself is not fair.
7,800.
So then we bring their share of impairments. But don't forget, we only share the impairment because that is what because NCI is measured as fair value. If NCI was measured as proportionate share, the parents would have been the only one to bear the impairment. So share of impairment, we have 60% of the 600, and that will be 360. That would be 360. What else do we have? Oh. Okay. So I don't think we have any other thing we haven't taken care of. So what's the summation?
42,590.
42,590.
Sir, I have a question, sir.
Go on.
So, sir, please, this gain on bargain purchase, why is it included in the share of post-acquisition earnings?
If they are selling something for or something worth 3,000, or I
Yes.
was able to buy 2,008, that gain is
200.
in an addition to my cash or not?
Okay, the addition.
That's that. So like the bargain, and they were able to save some money on what they are acquiring. So it's additional gain for the church.
Okay.
So we have consolidated statements of financial position. As at 31 December 20x9. Okay, we have what? Dollar in thousands, non-current assets, PPE. What is the PPE? We have 14,500 plus 12,140 plus 17,500. And we'll look at our adjustments. Is any of it affecting PPE? Yes. We have debit PPE with 1,000, with 3,000, credit it with 1,000, debit it with 2,000, credit it with 1,000. So I'll say plus 3,000 minus 1,000 plus 2,000 minus 1,000. Figure. And I think with that, we've taken care of all of the adjustments we have. Then we have 27,140.
47.
Okay. So all these investments in rifle and investments in pistol, we've already taken care of that. That's the essence of our consolidation. We just bring the goodwill as consolidation here. Goodwill as consolidation is what? 1750. 1750. Then current assets. We have inventories. Inventories, we have what? 6,003 plus 2,001 plus 450. No adjustments. Trade receivables. We'll have what?
Inventory is
4,000.
8,850.
I'm coming up plus 2,000 plus 2,320. What do you say?
Inventory is
Inventory
885.
88.
50.
50.
Okay. What else do we have?
Receivables
Okay. How much?
9220.
9220. Okay. I think that is all we have on the asset side.
Cash
What do you say?
for cash
Yes.
2455.
2455. Please, total
So the
assets.
total is 69,415.
69,415. So for ordinary share capital, we have what? 5,000. retained earnings, which is the consolidated retained earnings, we have what? 590. Then what else do we have? So that will give us 47,590. Then aside that, we also have what? NCI. And NCI is what? 3,580 plus 280. 3,580 plus 8,280. Okay.
11,860.
Huh? What do you say?
11,860.
Okay, our current liabilities is what? 5,700 plus 2,280. Figure.
For the equity,
Yes,
59450.
I don't understand. This one is 59450.
Equity,
Which equity? We've calculated shareholders fund. NCI should be
ordinary,
11,000.
everything.
There is no way I want to get everything if I don't know the individual figures now.
11,860. That's NCI. Then current
The
liability
current liability
9,965.
9,965. So summation is what? What do we have?
69,415.
69,415. Ladies and gentlemen, that will be all for today. You can practice the
So,
question too.
sorry, sir. Please,
If you
can you
have
scroll up? I want to
question,
confirm something, sir.
you can check this thing. If you have any question, you can reach out to me through the group chat. Any other question?
It's concerning the revaluation surplus. Why we didn't touch it and why it's not affecting the account. I wanted, like, if you can
Touch
throw
it
more light.
now. Don't forget, it is for subsidiary, and we've used it in calculating net asset summary.
Okay, okay.
Any other thing?
Hello, sir. I
Okay.
sorry, I observed that while you were calculating current assets and current liability, you make use of the sub. But coming down to current current assets and no current assets, you make use of sub the figures. But under current
Yes.
liability, it ignored them. I don't know what could be the reason. And
Maybe you did not check. Under current liability, I still use all of it.
no, I did not see 1985 there.
Still for driving factor.
You did not
Yeah?
see 1985.
Yes.
Look at this coin very well. Because this is 1985 here. Or am I the only one seeing it?
Is there?
Okay. Any other question? Any other question? Ladies and gentlemen, enjoy the rest of your evening. Bye.
Are we getting the video immediately?
Video, okay. Bye, ma. If you cannot get video immediately, you'll get video tomorrow.
All right. Thank you.
I never comment.